All right, welcome to the Explainer. Today we are stepping right into what is easily the most heavily fortified sector in our entire modern economy. We're talking about the legal fortress of banking and finance. We're going to take a comprehensive, deep dive into this 5-unit syllabus covering the Banking Regulation Act, negotiable instruments, and Sarfazi. Think of this as your high-stakes briefing on the absolute rules that control, well, literally every single transaction, deposit, and debt in the financial system. So here's our battle plan for today. First up, building the walls. Then, entering the gates. Third, the currency of trust. Fourth, the gatekeepers. And finally, breach and recovery. Let's get right to it. Unit 1, building the walls, which covers the framework of banking regulation. Now, you gotta understand, before 1949, banking in India was essentially the Wild West. It was unregulated chaos leading to massive joint stock bank failures and huge losses for everyday depositors. So to stop the bleeding, the state had to systematically build these regulatory walls. It started back in 1934 with the RBI Act, establishing the central bank. Then came the absolute cornerstone, the Banking Regulation Act in 1949. Fast forward, we marched through the nationalization of major banks in 1969 to broaden the reach, and then finally moved into modern heavy-duty enforcement with the Sarfazi Act in 2002 and the Insolvency and Bankruptcy Code in 2016. Every single one of these milestones, just another layer of heavy armor for the financial sector. Which brings us to a crucial question. What actually legally constitutes banking? Well, under Section 5B of the 1949 Act, the definition is incredibly precise. It is strictly the acceptance of deposits of money from the public specifically for the purpose of lending or investment. And here's the kicker. These deposits absolutely must be repayable on demand or otherwise, and withdrawable by check, draft, or order. Seriously, if an institution doesn't fit this precise English legal definition, it literally cannot call itself a bank. And over all of this, under Section 22, it's the RBI that holds the absolute licensing power. They decide who opens the gates and who gets shut down. Let's look at who actually operates inside these walls today. You've got your commercial banks. Think SBI or HDFC. They're profit-driven, engaging in heavy commercial lending. Then you have cooperative banks, which are member-owned for mutual benefit. But look at payment banks. Introduced in 2015, entities like Paytm or India Post Payments Bank. They're like the new restricted guards of the fortress. They can accept deposits up to 2 lakh rupees, but they absolutely cannot lend, no lending whatsoever. They are purely built for payments and remittance. All right, moving on to Unit 2, entering the gates, the banker-customer relationship. Okay, listen closely here because we're about to shatter a very common illusion. The moment you walk into a branch and hand your cash to a teller, that money is no longer yours, period. You might think the bank holds it in some little vault with your name etched on it, but no. The primary legal relationship is debtor and creditor. You are the creditor, the bank is the debtor. The money legally belongs to the bank to use for its own lending, and it merely owes you a debt. Now sure, there's a secondary relationship, trustee and beneficiary, but that only applies in super specific circumstances, like when a bank holds funds strictly for a directed investment. But your everyday standard savings account, you are simply an unsecured creditor. This entire foundation was actually cemented over a century ago in the landmark 1921 case Jacobson v. Swiss Bank Corporation. Picture this for a second. A customer dies abroad, right? This sparks a massive dispute over when the legal time limit to recover his deposited funds actually started ticking. Was the bank a trustee guarding his money or just a debtor? Well, the English Court of Appeal laid down the law. It is strictly debtor and creditor. But, and this is a huge catch, the bank doesn't actually owe you until you explicitly demand it. Therefore, the clock on recovering your money starts from the exact date of demand, not the date of deposit. And guess what? That ruling still governs your bank account today. Pivoting sharply now to Unit 3, the currency of trust, covering negotiable instruments and checks. So if the bank is the fortress, negotiable instruments are the secure vehicles moving wealth within its walls. And to understand these vehicles, you really need to know about a position of unparalleled legal power under Section 9, the holder in due course. Here's how it works. If you acquire an instrument, let's say a check, for consideration before it matures, in good faith, and without knowing of any shady business going on, you get what's called a clean title. This literally means even if the guy who gave you the check originally got it fraudulently, your right to that money is totally bulletproof. Let's see how this applies practically to the physical checks you use. There's a stark difference here. Take an open check. It's payable directly across the counter to anyone holding it. the bearer. It carries a massive, massive risk of theft. But if you add a general crossing, meaning just drawing two simple parallel transverse lines on the face of the check, its legal nature completely transforms. It can no longer be cashed right at the counter. It must be routed securely through a bank account, providing an absolutely essential layer of traceability and safety. But what happens when that paper vehicle crashes? Welcome to Section 138 of the NI Act, Dishonor of Check. This is a strict procedural countdown. Listen to this. Step 1, the check must be for a legally enforceable debt. Step 2, presented within 3 months. Step 3, it bounces for insufficient funds. Step 4, the payee must issue a written notice within 30 days of the bounce. And Step 5, the drawer fails to pay within 15 days of receiving that notice. Let me be perfectly clear here. Missing even a single step reduces this to a sluggish, drawn-out civil dispute. But execute them all correctly, the drawer faces a criminal conviction with up to 2 years in prison. No joke. Now, this high-stakes reality triggered an absolute jurisdictional war in the Supreme Court case Dashrath Rup Singh Rathod v. State of Maharashtra. Creditors were playing dirty man. They were depositing bounce checks in far-flung cities just to legally harass debtors. So it begged the question, where exactly do you file a bounced check lawsuit? Initially, the Supreme Court cracked down hard, ruling you had to file where the drawer's bank dishonored it just to prevent abuse. But Parliament actually fired back. With the 2015 amendment, they shifted the power entirely, establishing that you file the lawsuit right where you, the payee, maintain your own bank account. Let's head into Unit 4, the gatekeepers, looking at paying and collecting bankers. We're looking closely now at the specific legal duties of the institutions standing directly at the vault doors, handling these instruments. The law separates them into two distinct roles, each with statutory shields. First, the paying banker, under Section 85. That's the drawy bank paying out the funds. They are legally protected if they make a payment in due course, meaning they verify the signature and the apparent tenor of the instrument without negligence. On the flip side, the collecting banker, under Section 131, is the one receiving the funds for the payee. They are shielded from liability even if the customer's title was defective, provided they collected across check in good faith and without negligence. And nowadays, without negligence firmly means strictly adhering to KYC, know your customer protocols, to protect your identity and your funds. Finally, Unit 5, Breach and Recovery, covering loans, guarantees, and SARFACI. All right, lowering the voice a bit here because we gotta get to the gritty reality. Sometimes the currency of trust breaks down, loans go bad, and when that happens, banks roll out the heavy artillery. Here's the banker's arsenal for securing their advances. First, the general lien under Section 171 of the Indian Contract Act. This is a unique, sweeping power, allowing a bank to retain almost any property of the customer currently in its possession just to cover a general balance of debt. Second, a pledge under Section 172. This is a bailment of movable goods, like gold, where the bank takes physical possession as security. And third, a mortgage under the Transfer of Property Act, which is a formal transfer of interest in immovable property, like land, to secure something like a housing loan. 3 distinct, unbreakable legal grips. But what about those massive, high-stakes corporate promises? Well, in UP State Sugar Corp v. Sumac International, a huge dispute erupted when UP Sugar tried to block a bank from paying out on a bank guarantee. The Supreme Court stepped in and laid down an ironclad rule. A bank guarantee is an absolutely independent, autonomous contract. The bank cannot look at the underlying drama between the parties. It must pay on demand. The court ruled they will only block this in 2 extremely rare exceptions: egregious fraud that is actually known to the bank, or special equities that would cause irretrievable injustice. That's it. Now, when all else fails, banks deploy what is arguably their most ruthless court-free recovery mechanism, the SARFACI Act of 2002. Here is exactly how Section 13 weaponized debt recovery. Step 1, the borrower defaults, and the account is officially declared a non-performing asset, or NPA. Step 2, the bank issues a strict 60-day legal notice demanding payment. And Step 3, if it remains unpaid, the bank legally bypasses the civil courts entirely, literally skips the courts. They can directly seize possession of the secured asset, take over management, or forcefully sell the property right then and there. Naturally, borrowers were furious and asked, is bypassing the courts like this even constitutional? The Supreme Court answered that in the landmark 2004 Mardia Chemicals case. Corporate borrowers claimed SARFACI violated their fundamental right to due process. But the court shot that argument down, ruling that clearing out the crippling level of NPAs was a valid public interest, which completely justified quick, court-free recovery.
However, they did find one massive flaw. The act originally demanded borrowers deposit an unconscionable 75% of the disputed amount just to file an appeal. The court struck down that 75% rule to protect the right to a fair appeal, but fully upheld the rest of SARFAC, forever cementing the bank's aggressive recovery powers. Wow, okay, we've covered a ton of ground today. We navigated the strict laws of banking definitions, the harsh realities of being a debtor, the precision of negotiable instruments, and the absolute firepower of modern debt recovery. But before we wrap up this explainer, I want to leave you with one provocative final thought. If this massive, carefully constructed legal fortress was painstakingly built for paper checks, physical branches, and tangible assets, how will these rigid, centralized laws possibly survive the decentralized, borderless explosion of cryptocurrency? It's a legal earthquake that is already shaking the foundation. Something to think about, right? Thanks for joining me for this explainer, and I'll catch you next time.